Hello, gang. My name is Ian Carnell, and I serve as the Chief Revenue Officer of Trulytics, coming to you from Austin, Texas. The title of today's presentation is How Buy-Side CEOs and their M&A teams can conduct 20 target firm valuations in 10 hours, saving $140,000 in consulting fees, closing 3 deals successfully, increasing revenues by 28% and AUM by 46%. We have a lot of ground to cover today. Let's first start by backing up the headline with some proof. The case study below depicts how Tom Mauricio, CEO of Modera, and his internal M&A team evaluated 20 target firms from 2018 to 2020. In that time frame, Modera successfully closed 3 of those deals, contributing to the firm's growth, both revenue and AUM. Tom and his team concluded that Trulytics valuation reports were on par with valuation deliverables received from outside consultants, and that by utilizing Trulytics versus traditional consultants, Modera saved $140,000 in consulting fees and a total of 1,670 hours of effort. Modera's relationship with Trulytics allowed Tom and his internal team to conduct valuations at a massive time and cost savings, and has become a central tool to their M&A strategy moving forward. Modera, by embracing digital transformation of the valuation process, significantly improved the way that they can target, analyze, and close strategic growth opportunities without the significant cost and expense related to traditional methods. In this presentation, I want to explore numerous ways that embracing digital transformation as part of your M&A strategy can improve your team's ability to better identify high-quality RIA targets, increase deal volume and velocity by leveraging digital workflows to conduct valuation calculations, and improve deal alignment by connecting those valuations to quantifiable business performance metrics. Tom understands that the market is only becoming more competitive, that quality RIA targets are shrinking every single day, and that he must utilize innovative tactics to maintain his competitive advantage in the market. Let's talk about market trends. As we all know, the market is red hot. In a recent report published by Echelon Wealth Management Partners, Q1 of 2021 set an all-time record of RIA M&A deal volume in a single quarter. If you Google RIA M&A trends, let's do that, you can easily find that all trend charts are going up and to the right. Deal volume is increasing, more buyers are entering the market, and sellers are motivated to access liquidity and mitigate the fact that many lack a succession plan. Another report recently published stated that over the next 5 years, mega firms will consolidate the market further and control 70% of assets under management, meaning that 20% of firms that exist today, that are operating today, will either be acquired or eliminated in the next 5 years. Why is this important? Well, according to the 2020 RIA Deal Room for Advisor Growth Strategies, deal volume trends suggest a flight to certainty. Buyers will need to decide to compete with acquisition brands head-on or develop a niche acquisition strategy. Potential buyers have the opportunity to compete regionally or appeal to underserved market segments, such as smaller RIAs or boutique firms. I would also add that buyers need to consider ways to transform their acquisition strategies to embrace digital transformation that will give them the additional advantage and leverage that they'll need to compete in this market. It is a seller's market to a certain extent. According to Fidelity study titled M&A Valuations and Deal Structure, Insights from Leading Serial Acquirers, median EBITDA multiples for deals between 2017 and 2019 has risen to 7x, up from about 5x in 2014. An increase in valuation is a good news story for potential sellers. As more buyers enter the market, they'll have more options for an exit, but also more complexity. Sellers will have to be more strategic about how they approach M&A, as only the most attractive firms, those that are demonstrating stable organic growth, the ability to attract a younger client demographic, best-in-class platforms, and top talent will be in a position to command premium valuations and have great exit strategy options. Well, that's good news for RIA firms that are deal-ready today. Fidelity's research also found that sellers may have inflated expectations of the multiples they can realistically receive. In fact, they found that sellers' EBITDA expectation multiples were between 8 to 10x. However, there remains relatively low conversion rates across firms of all sizes. Despite the increased M&A activity, sellers' emphasis on high multiples often appear to slow and even derail many transactions. The study identified that 91% of buy-side firms attributed unrealistic market-driven comparison multiples as the primary cause for sellers having such inflated valuation expectations. For most firms considering a sales, it is their first time to engage in this process. And as small business owners often do in most industries, they initially overvalue their business and focus on exceptionally high publicized transaction multiples, as well as their own personal financial needs to ensure the continuation of their current cash flow. So as the competition for high quality RIA targets intensifies, let me ask you another question. How do you plan to compete? Well, my presentation today is for you, for those CEOs, founders, general partners, or lead the M&A teams of your firms actively conducting M&A and or succession planning with other RIAs. You're interested in discovering quality firms that are profitable, have stable, growing revenue streams, leadership talent, and can expand your geographic footprint, but lack the ability to efficiently identify these targets. You've engaged in valuation and or transition consultants in the past, but all they did was cost you time and money. You've been frustrated by deals falling apart as you wait weeks, sometimes months, for your consultants to turn around their deliverables. You've been unable to gain alignment with sellers on valuation expectations and are compelled to find ways to increase your conversion rates. You desire to maintain valuation discipline essential to your M&A strategy, and you seek an advantage in today's increasingly competitive market. So here's the truth. You can continue to leverage traditional M&A methods and consultants as you look to capitalize off of this increasing wave of RIAs looking to sell. However, identifying high quality RIA targets will increasingly become more difficult as the market becomes more competitive using traditional benchmarking studies and data brokers. The time and cost to complete valuations will be a gating factor, both time and money, to deal volume and velocity. That market-driven seller expectations will continue to drive lower deal conversion rates without a better framework to improve valuation alignment and success rates. Trulytics Advisors Transition Management Platform is the only SaaS platform purpose-built for the wealth management industry to solve this problem. Let me share with you a little bit about our background before I continue. Jeremy Carnell is one of the co-founders and serves as CEO of Trulytics. He is also my identical twin brother and entrepreneurial wingman. He and I have over 20 years of executive experience in companies ranging from early stage business and startups to the Fortune 500. And we have expertise in digital transformation, digital product innovation, and development and marketing. We are serial entrepreneurs and have founded 4 companies together, including one which we have scaled to over 100 million in gross revenue and over 200 employees worldwide. We have significant business expertise in operating and scaling digital platforms that have led significant operations in the United States, United Kingdom, and Singapore. In late 2013, Jeremy and I sold a startup we co-founded called OfferGraph to Polygraph Media in Austin, Texas. OfferGraph was an early stage multi-tenant SaaS platform that allowed brands to identify, connect, and monetize relationships with key influencers and their social networks. We acquired OfferGraph's core IP and team from Harvard University, which was beta testing the technology with major social networks like LinkedIn at that time. Prior to this, we founded One-to-One Interactive, a digital agency based out of Boston, Massachusetts. As its president, Jeremy played a major role in establishing the firm's position as an industry leader in online customer insights, activation, and cultivation. Jeremy also managed the US and international sales and marketing teams, generated over 20 million in net digital marketing revenue with a 40% CAGR from 2005 to 2012. I oversaw the firm's operation as its CEO and led our M&A strategy, completing strategic acquisitions across the United States, England, Singapore, and Brazil. Under our leadership, One-to-One was recognized as one of Fortune magazine's fastest growing companies, B2B Magazine's Agency of the Year, and Ad Age's top 100 agencies in the United States. Jeremy and I both hold a bachelor's degree from Wabash College. Terry Mullen is the other co-founder of Trulytics and is a successful, seasoned business executive, board member, entrepreneur, and active private investor. He's nationally known for international expansion, distribution models, and strategic partnerships, following a 25-year career in financial services. He has served as president and CEO of Lincoln Financial Distributors, where he led a 1,200-person team that generated $25 billion in revenue. He served also as VP U.S. distribution for Sun Life Financial. At Sun Life, Terry was responsible for aligning and developing the sales organization across all employee benefit lines of businesses in the United States. Terry holds a bachelor's degree from the University of Delaware. On January 1, 2017, a small group of entrepreneurs led by Jeremy and Terry launched Trulytics, the industry's first advisor transition management platform. They recognized a massive opportunity to transform the way the wealth management industry discovered opportunity. They specifically identified a massive opportunity to disrupt an industry dominated by professional services to support valuations, mergers and acquisitions, succession planning, recruitment, and practice management by creating a SaaS business intelligence platform focused on business performance and transition management. Their vision was to build the first end-to-end data-driven system to help wealth management insurance enterprises attract, grow, and retain advisory businesses while massively reducing the time and the costs related to these transactions. In 2018, Trulytics 2.0 was launched in the marketplace, introducing more robust enterprise features. As a result, Trulytics landed 56% of the top independent broker-dealers customers in its pipeline and grew by 7,000% that year. In 2019, Trulytics scaled its database of financial advisory firms from 300 to over 7,000 in less than 12 months. And in 2020, Trulytics 3.0 was launched to the marketplace, introducing 3 new modules purpose-built to supporting recruitment, TrueRecruit, emergency continuity, our True Continuity module, and firm matchmaking, our TrueMatch module. This rollout fulfilled Trulytics' promise of architecting the first complete advisor transition management platform in the wealth management and insurance industries. To date, over 11,500 financial advisory firms have used Trulytics for business performance optimization and transition management. Both buyers and sellers have a standard methodology leveraging Trulytics Advisor Transition Management platform to accurately, affordably, and efficiently value a financial advisory business to support practice management, emergency continuity, succession planning, and M&A. Trulytics has become the leading SaaS business intelligence platform for wealth management enterprises focused on business performance and transition management. We've been selected by some of the biggest names in the sector to provide actionable business insights and key performance indicators. Trulytics lays claims to the single largest database of financial advisory, health, and wellness records in the United States, with over 26,000 firms profiled and indexed on our platform. 43% of those firms being the first-party data relationships that we have with our 11,500 customers today, and the balance are the secondary data relationships that we have from the 15,000 registered RIAs profiled through their Form 80V submissions to the SEC. We've received quite a bit of recognition from the industry over the last few years. Most recently, Investopedia recognized Trulytics as the best analytics platform in practice management software of 2021. In this next section, we're going to begin to address specific areas where digital transformation can drive step function improvements in the M&A process. Our first thesis is in the area of target discovery. Traditional discovery funnels can be found today in annual benchmark studies, the product and services of traditional data service providers, or DSPs, and through traditional M&A deal brokers. Their constraints primarily pertain to the fact that their data and insights sit behind paywalls, meaning that you must pay to get access to this data, thus creating information asymmetry for those who don't pay to play. Further constraints pertain to the fact that most of this data contains very limited insights, particularly related to the health and wellness of the RIA, either due to the fact that it is not real time and or has limited enrichment with respect to business performance KPIs. Alternatively, data content loops democratize this uncommon knowledge. Use of data content loops traditionally disrupt traditional discovery funnels, for they, 1, democratize information for markets instead of hoarding information behind paywalls. 2, solve for information asymmetry that only advantage incumbents or those willing to pay to play because they are free. And 3, they create unique, incredible insights that verify the legitimacy of information being shared, incentivize participants to update the data that is being collected and shared with the commons, and enrich the data to provide truly unique insights. Data content loops are not typically subjects discussed in the wealth management sector, similar to how they were not discussed in real estate, jobs, or travel, until Rich Barton leveraged them to completely disrupt each one of those industries by launching Zillow, Glassdoor, and Expedia, now each worth well over $1 billion. Rich Barton's career can be summed up by his mantra, power to the people. His companies take power from the incumbents and give it to consumers. Instead of trying to hoard information, they are on the side of the consumers by giving them more data transparency. Glassdoor revealed how employees really felt about companies. Zillow shed light on what houses were worth. And Expedia let people see the prices and availability of flights and hotels without talking to an agent. Again, traditional discovery funnels can be found today in annual benchmarking studies that cost $25,000 on average to access, like the Schwab study. The products and services of traditional data service providers, like Discovery Data, which charges you a fee to access their data, and through traditional M&A brokers, excuse me, that gate their data so that they can charge retainers and success fees to access their knowledge, thus creating information asymmetry, as we've already discussed. Data content loops provide an alternative to traditional discovery funnels. A data content loop targeting RIAs would look something like this. Step one is that the platform creates RIA peer benchmarks for internal and external consumption, leveraging existing first or second party data sources. RIAs discover their peer benchmarks via word of mouth, Google, or through the enterprise they're affiliated with. RIAs in step three enrich their firm information in real time, leveraging digital workflows that streamline data ingestion. In step four, RIAs receive unique insights through practice assessment scorecards, grades, business performance KPIs, and RIA peer benchmark cohorts. Step five, the RIAs connected will access communities to share knowledge and insights with respect to practice management goals, need for succession solutions, and continuity planning. And in step six, RIAs are able to leverage this unique data insight to drive improved performance internally and externally better position their practice for transition consideration, thus discoverability. This loop is continuous and drives increasingly more RIA engagement, data sharing, community expansion, and discovery over time. The question is, does this exist today? The answer is yes. Trulytics launched RIAbase.com, a data content loop for RIAs in 2020, and it's completely free. Our strategy was to Zillify the entire wealth management industry by creating the largest health and wellness database of RIAs in the marketplace and make it available to the public, again, at no cost. Let's take a few minutes to explore the platform. So when you log into RIAbase.com by visiting the URL, you're first asked to enter in a query, a firm name, a CRD, really anything. It could be a location like Boston. When you click search, it will bring up 350 results that we find on Boston. So you can scroll through each of these results on the left. And before I actually do that, there are other ways that you can filter to discover these RIAs. I just put in keyword Boston. If I actually put in Boston location, expect we'll generate more results. Yeah, instead of 330, we have 635 results now. You can also search by AUM, min and max, by types of clients, by the types of service, and you can continue to filter the results that way. As you scroll through the results, you can then click into different advisors that you see and generate a peer benchmark, either from their SEC peer group or from their Trulytics peer group. As the site states, a firm's peer group is calculated from an SEC perspective based on their public self-reported AUM benchmarked against a population of RIAs who submitted the Form ADV to the Security and Exchange Commissions. And we benchmark them against their peer group, looking at a number of different KPIs associated with their business, their clients, and their services. And so when you click on business, you can look at firm age, structure, discretionary accounts. We bubble up about 50 KPIs across these three categories in RIAbase.com. as a way for anybody who is searching for a particular type of RIA to not only get standard information that can be found in their Form ADV data, but additional insight with respect to how they stack up against their peer groups. So we've been looking at their SEC peer group. Let's take a look at their Trulytics peer group. Now, a Trulytics peer group is a benchmark calculation based on the average data in a group. Peer groups are dynamically generated via not only the self-reported AUM mapped against the Trulytics database of 8,000 firms and their self-reported data, but also those additional business stability grades, client stability grades, and market stability grades. We also provide 3 different valuation benchmarks for this individual firm based on peer group insights. So for this particular firm, we give them a Trulytics score of 2.9, and the score is an easy to understand number. It's like a GPA that gives you an overall quick sense of the health of the business. It combines insights from every aspect of the firm's business, client, and market stability scores. And as a result, we can then get some initial valuation calculations from that based on our peer group insights. We give you discounted cash flow, multiple of EBITDA, and multiple of EBOC. Now, in our platform, we give you a 4th one, which is multiple of revenue as well. Firms can, if they own the firm, claim their page. There's a simple process for claiming the page. It must be a firm principal. They fill out their first name, last name, the firm name, and the business email. And one of our associates will work with them to enable the page to be claimed. If you are on the buy side and this firm interests you and you want to follow the firm and get real-time alerts based on any data that gets updated, you can also fill out this form. So what we have learned in comparing data content loops with traditional discovery funnels is that in the old way, it involves spending money with traditional information brokers. The constraints are monetization gateways, limited insights, lagging data because annual benchmark surveys by definitions only get updated annually, and information asymmetry. Only those that are willing to pay can play and have that information. The cost can be somewhat high, from $15,000 in licensing fees to DSPs to $25,000 to access an annual benchmark study, to significantly more than that to engage M&A deal brokers who charge retainer fees and success fees, versus leveraging data content loops or RIA-focused data content loops that help you discover high-quality RIA targets. 1, it's 100% free. 2, we have democratized this knowledge. We have taken uncommon knowledge and have made it common. We've leveled the playing field as a result, and we can generate unique and real-time insights with our peer benchmarks, our Trulytics scores, and our valuation calculations. So some questions that you might be asking: how many RIAs have been indexed on RIAbase.com? So over 26,000 firms, 15,000 plus of the SEC registered RIAs, and over 11,000 Trulytics advisory firms that are currently on our platform. Does it cost money? As we've already talked about, no. RIAbase.com is 100% free. Does Trulytics own RIAbase? Yes, we launched RIAbase in 2020 to Zillify the entire wealth management space. Am I able to use RIAbase for my discovery initiatives? Yes, you can search and follow RIAs based on a multitude of firm characteristics. What is the process for claiming my RIAbase page? Well, if you're an owner of one of these RIAs and you want to claim your page, simply click on the Claim Page button on the firm page, fill out your contact information. As I said before, you must be a firm principal, and one of our team members will get back to you. Our second thesis is in the area of leveraging digital platforms to streamline and enhance valuation methods. Leveraging digital platform workflows, analytic capabilities, and big data can fundamentally transform the way that you are currently conducting your valuation calculations. Third-party digital platforms represent independent and objective valuations. Digital workflows and APIs can significantly reduce data capture and processing friction, streamlining due diligence efforts. Analytic capabilities allow for multiple valuation calculations simultaneously with no additional inputs, labor, or effort. Digital workflows also remove process constraints, limiting the number of target firm valuations you can conduct simultaneously, significantly improving overall deal volume and velocity. Lastly, big data insights unlock unique valuation insights. Traditional valuation processes, as we know, take approximately 4 to 6 weeks and cost on average $10,000 per evaluation. Now, some evaluations will cost less, 25 to 500. Some will cost more, up to $20,000. We're using $10,000 as an average. The 4 to 6 week process, we pulled this directly from Mercer Capital's website, where they articulate their valuation process steps. Where immediately they can initiate a call and begin scope of work. They provide an engagement letter and information request to clients, and then begin the due diligence process. Initial research based on information from clients, that's going to take about 2 weeks. Management interviews and due diligence visits, another 2 to 3 weeks. Analysis and report prep, another 2 to 3 weeks, and then final report production, which may take, depending on the number of versions and refinements, another 2 to 3 weeks. Let's just say on average 4 to 6 weeks, and again on average $10,000 per valuation. So a new approach to evaluation is to embrace digital transformation of the process. And as we've outlined here, it incorporates 4 elements. First, value innovation, leveraging new tools and data to enhance the valuation method. Digital connectivity, leveraging digital provisioning to streamline the due diligence process so that it doesn't take weeks, it takes minutes. Digital fulfillment, allowing for full straight-through processing of valuation calculations. Replacing labor with technology, radically reducing the cost and time it takes to generate the calculation and to be able to share the calculations. Enhanced control, improving insights and decision-making by leveraging big data and enhanced analytics. The result is to transform this entire traditional valuation method and process from 4 to 6 weeks to 30 to 45 minutes. Also radically reducing the costs associated with conducting these valuations. So no longer does your traditional valuation methods have to be a gating factor to the number of deals that you're analyzing or considering as part of your M&A strategy. You can now conduct, as we've talked about, multiple valuation processes with multiple target firms simultaneously, because you no longer have both cost and time as gating factors. Matt Smith and Wealth Distribution Strategies recently licensed Trulytics. They're one of our newest customers to support their M&A efforts. Now, the business case for their decision to license Trulytics was the fact that their M&A strategy called for identifying and evaluating 20 target firms a year over the next 3 years. It's 60 firms that they wish to evaluate over the next 3 years, with the anticipation of closing 2 to 3 of those firms each year. So 6 to 9 closed firms by the end of the year to drive accelerated growth to their revenue and to their AUM. Matt estimates his cost savings at about $540,000 by leveraging Trulytics versus utilizing traditional consultants and methods. Another proof point. So when we look at the old way versus the new way, with respect to valuation calculations, the old way involves spending significant time and money for traditional consultants to conduct these valuations. We know the constraints are cost and time per calculation, 4 to 6 weeks and $10,000. Where the new way involves digital transformation of this process, that new digital tools and data can enhance traditional valuation methods. Digital provisioning streamlines the due diligence intake process. Full straight-through processing of valuation calculations enable real-time access of the calculations and sharing of the calculations with your team and with target firms, and improved real-time information systems and decision-making, leveraging big data and analytics that provide more unique insights into those drivers that are producing the valuation, the risk factors in particular. We're going to talk about that in this next section. We do have some tools that you can leverage to calculate savings. So if you're in the market and you're looking for what your potential savings could be to rationalize a business case to license a tool like Trulytics, we provide some simple calculators for you to do that. And you can find this calculator on this landing page. Just scroll down and you'll find it embedded within the landing page. And it's quite simple. We simply ask the total number of deals that you plan to evaluate per year. You can just slide the slider back and forth to 0 or all the way up to 20 plus deals. however many your M&A strategy will calls for, and we give you the total cost savings as a total cost as a percent, and total time saving in hours. So in this case, if you're anticipating conducting 20 deals a year, you'll save about $180,000 in consulting fees annually, which is a 90% savings leveraging Trulytics versus a consultant, or leveraging any third-party platform that enables digital tools to drive valuation calculations, and then a total time savings of 4,800 hours. As we discussed at the beginning of this presentation, low deal conversion rates continue to plague the market for firms of all sizes due to the lack of deal alignment, particularly with respect to valuation calculations. Many sellers are going through the process for the very first time and have inflated market-driven value expectations based on highly publicized deals. Sellers typically lack the tools to articulate their intrinsic value and market differentiation, leveraging practice scores, peer benchmarks, or other tools. And buyers are attempting to maintain M&A discipline in an increasingly competitive marketplace and lack the tools to quantify specific risk factors that are driving their valuation calculations. Thus, they are limited in their ability to articulate how they can best help the sellers address these risk factors through operating scale, client demographic, succession, et cetera. We know that there's a low deal conversion rate. In fact, 2 in 5 RIA deals fall through due to unrealistic value expectations, according to Fidelity's M&A valuation and deal structure study, looking at insights from leading serial acquirers. Buyers and sellers come at valuation from very different perspectives. Both parties struggle to explain their rationale for leveraging a specific methodology to help the other understand how they are measuring value. According to FA Insight's Merger and Acquisitions Focus Group, this is the #1 deal roadblock cited by advisors. Bankers and transition consultants rarely can identify specific and quantifiable business performance metrics that uncover how value is being calculated and discounted. Negotiations rarely lead to deal frameworks where both transacting parties agree on all terms. So crossing the great divide between buyer and seller value expectations requires a completely new approach, one that helps buyers identify specific and quantifiable business, client, and revenue gaps, risk factors that are discounting the seller's enterprise value, that also help buyers communicate to the sellers how their organization will address these risk factors, and help them structure more mutually beneficial deal frameworks that incentivize the seller to address practice gaps in order to maximize total value potential through earnouts or other methods. And it will also help sellers communicate to buyers how their organization stacks up against similar sized peers, utilizing benchmarks and scorecards. This will help them be able to hone in on areas where they are strong. For both a buyer and a seller, it's important to note not only their own motivations for pursuing the deal, but also those of the other party. Sellers, for example, may be interested in liquidity and offloading operating activity, but they need to demonstrate how they will help the acquiring firm to grow and improve client service. Often, a third-party independent platform can help a firm articulate its value to a buyer more objectively and effectively than the firm can on its own. Likewise, buyers need to communicate how their organization will address the gaps that a seller who is in the driver's seat in many cases wants to close. How will they help firms improve operating scales, implement competitive service models, and address leadership succession challenges? Third-party independent benchmarking platforms can help both buyers and sellers identify common ground when it comes to business performance KPIs that drive value, according to my good friend, John Solo, founder and general partner at Live Oak Wealth Advisory Group. So when we look at the old way versus the new way, the old way in driving deal alignment are leveraging market-driven expectations, seller transition consultants, or M&A bankers. And we know what that result is already, that 2 out of 5 deals fail today. So we need a new method. Leveraging third-party independent platforms to provide unique and objective business performance insights that are directly connected to value calculations can help improve these outcomes, can help improve the ability to drive alignment with the seller, can improve deal structures that maximize the potential value for both the buyer and seller. So in summary, by embracing digital transformation in your M&A process, we can help you enhance discovery of high quality RIA targets, increase deal volume by leveraging digital workflows, improve deal alignment by incorporating business performance KPIs as part of your deal structures, realize massive cost and productivity gains by replacing traditional labor and methods with technology, and feel powered, confident, and motivated with your transformed M&A strategy. So again, who is this for? We talked about this at the beginning of the presentation. Let's revisit it before we move on. Again, you're a CEO, founder, general partner, or you're leading the M&A team for your firm, and you're actively conducting M&A and or succession planning with other RIAs. You're interested in discovering quality firms that are profitable, have stable, growing revenue streams, leadership talent, and can expand your geographic footprint, but lack the ability to efficiently identify high-quality targets. You've engaged valuation and or transition consultants in the past, but all they did was cost you time and money. You've been frustrated by deals falling apart as you wait weeks, sometimes months, for your consultants to turn around their deliverables. You've been unable to gain alignment with sellers on valuations and are compelled to find new ways to increase your conversion rates. You desire to maintain valuation discipline as part of your M&A strategy, and you seek an advantage in today's increasingly competitive market. So let's talk about Trulytics and some of our features. First, let's talk about Trulytics peer benchmarking and how it works. We've taken the massive amount of data we've collected across all of our members and all firms registered by the SEC and have produced some data science magic. Firms are benchmarked against both their SEC peers, where there are over 15,000 SEC registered RIAs, and against their Trulytic peer groups of over 11,500 customers that we currently have on platform. Trulytic scores and valuations can be filtered against their peers with respect to business, client, and market stability scorecards, expenses, client details, and revenue details. Trulytics presents multiple valuations under different scenarios. Our methodology of choice is the discounted cash flow model, as this model best reflects future cash flow versus past financial performance. We include alternative methodologies to reflect industry expectations, but let's first start by overviewing the DCF model. The discounted cash flow methodology is usually the most widely used and accepted valuation method. The DCF model projects future cash flow and discounts it back to present day value. There are opportunities to lower the discount rate and improve a firm's valuations, such as increasing cash flow or improving KPI scores around business stability and revenue index models. The multiple of revenue approach considers 1% of recurring revenue plus the firm's non-financial drivers of value and calculates a value using industry rule of thumb multiples. The multiple of EBITDA approach utilizes income from operations and makes adjustments for interest, tax, depreciation, and amortization. This model then calculates a valuation using industry rule of thumb multiples. The multiple of EBOC approach, earnings before owner's compensation, is a measure of cash flow in advisory firms. This model calculates a valuation based on all earnings before compensation is paid to the owner. This model then calculates a valuation using industry rule of thumb multiples. Trulytics' suite of evaluation index models was developed by prominent industry thought leaders in response to the significant challenges facing financial advisory and wealth managers who are trying to accurately measure their success, plan for succession, and improve their bottom line. The foundation of our technology is based on data gleaned from tens of thousands of actual advisor tax returns, blind, state-of-the-art key performance indicators, and multiple investment banking formulas. The Trulytics score is an easy-to-understand number on a scale of 1 to 4, incorporating a firm's financial metrics, plus business, client, and revenue stability ratings. These ratings are broken out and graded A, B, or C, and directly impact a firm's discount rate, which drives their valuation. These scores and discount rates allow one to easily benchmark a firm against others in the industry and identify opportunities to grow or acquire or sell. Product risk is a component of the revenue stability as well. Though not necessarily detrimental, exposure to the markets can generate growth in good times. However, you should seek diverse revenue streams to counter the years with market losses. Stability can result, for example, from a mix of business services such as financial planning and products. Firms can also instantly generate PDFs of their evaluations or snapshot reports, leveraging our platform. Our evaluation report features 17 pages of key data and insights related to your latest Trulytics evaluation. The report is broken up into 4 main sections that include a report summary, business client revenue stability scorecards, your pro forma, and your valuation models. Our snapshot reports allow a firm to take a picture of the specifics of their annual report at any point. This allows a firm user to compare key performance indicators over time, including your Trulytics score, grades, firm value, and potential upside, or unrealized value, as we call it. You will also be provided with a detailed report that includes all your inputs and report outputs so that you can take a look back and see how the firm has evolved. So at this point, you may be asking yourself, what are the costs involved in licensing Trulytics and how do I learn more? The most important thing that you can do now is to click the Get a Price button below in order to schedule a 15-minute strategy call with me and begin the quote process. We have discussed the time and costs associated with traditional methods. Traditional benchmarking studies can cost as much as $25,000. Traditional valuation deliverables can cost on average $10,000 per valuation. And traditional firm performance analysis by a banker can cost as much as $75,000, if not more, depending on the size of a deal. So when we begin adding up the real cost, one is looking at over $100,000 per deal. Now, Trulytics provides a range of licensing options to our customers, ranging from $2,500 to $20,000 for an annual license. Most importantly, we offer 100% 30-day money-back guarantee. There's absolutely no risk to you. We are that confident in the value our platform will bring to your business. However, we typically limit onboarding to 20 new customers a month. Also, for a limited time, we're going to offer you one free accredited valuation from Owen Dow. Now, Owen sits as a board member on the Trulytics board, and he is the architect of Trulytics valuation algorithms that we use in our platform. Lastly, you'll receive one free hardcover copy of Owen's book, How to Value, Buy, or Sell a Financial Advisory Practice, a manual on mergers, acquisition, and transition planning. And the last time I looked on Amazon, I think that was a $99 value. So in overview, you will get access to Trulytics peer benchmarks, which will allow you to quickly benchmark target firms against their SEC and Trulytic peer groups to identify high quality RIA targets. You'll receive Trulytics evaluation models or access to our models that will allow you to quickly and cost effectively obtain 4 different valuation models purpose-built for the wealth management industry, allowing you to increase your overall deal volume. You'll get access to Trulytics evaluation index models, which will allow you to quickly assess the business, client, and revenue stability of a target firm to better drive deal alignment and mutually beneficial deal frameworks that lead to higher conversion rates. You'll also get access to our dynamic reporting that will allow you to instantly generate PDFs of the latest evaluation or snapshot reports so that you can easily share with your team or target firms. You'll get one free accredited valuation conducted by Owen Dow, and you'll get his book, one free hardcover copy of Owen's book, How to Value, Buy, or Sell a Financial Advisory Practice, a manual on mergers, acquisitions, and transition planning. Now, I'm anticipating some questions that you might have at the end of this presentation. Are there any long-term contracts? We offer a multitude of different licensing options. We offer 1-year, 2-year, and 3-year contract options. What are the exact terms of our guarantee? Well, so at any point within 30 days of making a licensing purchase of our platform, if you're unhappy, you let us know and we refund your money. How is the valuation model kept current? Well, the Trulytics has a valuation assessment committee that meets on a semi-annual basis to review the existing model and algorithms. The committee is made up of industry consultants, investment bankers, and top advisory firm leaders. Common updates to the models include new data points, updated fields, and refinements to the calculations that generate the Trulytics score, market grades, valuation standards, and key performance indicators. How is the discount rate calculated on the DCF valuation? Financial advisory firms are almost universally recognized as nano-cap companies. That means they are already discounted versus a public company peer at a starting rate of negative 21%. Now, for firms with over 750 million in AUM, we use a graduated scale. Once the starting discount rate is defined, negative 21% for all firms under 750 million, as we just discussed, 20% for firms between 750 million to 1.6 billion in AUM, and graduating down from there to a minimum of 15%. The Trulytics evaluation adds in an additional 5% discount in each of the three primary categories in the platform for business stability, client stability, and revenue stability based on a firm's score. This leads to a potential discount percentage that ranges from a minimum of 17% to a maximum of 36%. Trulytics takes the most likely discount rate and then provides a range of potential valuations based on EBOC that takes into consideration possible variations in the discount rate and applies that against historic cash flows. How are the potential impacts amount calculated? For most advisory firms, the Trulytics evaluation model will identify tens to hundreds of thousands of dollars in potential valuation impacts based on over 50 KPIs. These impacts indicate areas where the firm is leaving money on the table according to the marketplace. These can include dozens of issues ranging from whether or not the firm has an emergency continuity plan in place, to the average age of its clients, to how the business is utilizing or not utilizing technology. Our customers uncover on average about $350,000 in unrealized value opportunities in the first 12 months of leveraging our platform. How is a Trulytics score calculated? The Trulytics score is an easy to understand score on a scale of 1 to 4. Think college GPA. The Trulytics score takes into consideration all aspects of a firm's business stability, client stability, and revenue stability grades and boils them down into a single number. The score can be considered an industry standard snapshot of how a firm's operational processes are driving it towards success, and also an indicator of where it has room to improve, both in terms of valuation and revenue. I want to thank you for taking the time to watch this presentation. The QR code is a way for you to obtain my business card. Simply take your phone, point it at the QR code, and grab my digital business card. Most importantly, click the Get a Price button below and schedule a 15-minute strategy call with me. I look forward to chatting with you. And again, thank you for your time.